The story of this market cycle truly begins in the 1870s, a time when America was healing from civil war and Europe navigated a new political landscape. The world endured the Long Depression, a period where farmers watched their land lose value, factory workers faced endless wage cuts, and banks failed with alarming frequency, wiping out the life savings of trusting families. Yet in this darkness, seeds of recovery were planted. New technologies like the telephone and electric light emerged, promising magical transformation, while sprawling railroad networks created unprecedented opportunities for commerce and connection. As the 1880s arrived, the collective mood shifted and money began flowing into ventures that had seemed impossibly risky just years before. A pattern was taking shape. Economists looking back noted that the Long Depression was not an isolated event. It was followed by recovery, then another severe crisis in 1893, bringing bank runs and unemployment that rivaled the earlier despair. This crisis too passed, and the economy climbed to new heights in the early 20th century on waves of innovation. Then came the panic of 1907, requiring the personal intervention of financiers to prevent total collapse. The intervals were not perfect, but a rhythm was revealing itself, a heartbeat of expansion and contraction in the economic body. Nothing, however, prepared the world for 1929. The stock market crash ushered in the Great Depression, a catastrophe so profound it reshaped political systems and contributed to the outbreak of global war. The Roaring Twenties had promised endless prosperity. Families borrowed to buy shares, banks made risky loans, and belief alone sustained dizzying values. When the bubble burst, it was a grinding, relentless destruction of wealth that continued for years. Breadlines stretched through prosperous cities, families lost homes, and a quarter of the workforce was left without hope. Yet even this unprecedented disaster fit the emerging pattern, representing its most extreme expression. The end of World War II brought an economic transformation that seemed to promise escape. The United States, with its factories intact, emerged as a superpower, fueling decades of prosperity. Soldiers returned to opportunities their parents never imagined, buying homes, attending universities, and starting businesses. Suburbs sprawled, highways connected the nation, and a vast middle class enjoyed luxuries unavailable a generation earlier. For a time, it seemed economists had finally tamed the cycle through government intervention and monetary policy. But the cycle was not finished, it was merely resting. By the 1970s, stagflation and oil shocks revealed an interconnected, fragile global system that defied old certainties. In the modern era, the cycles seemed to accelerate. The crash of 1987 shocked a generation convinced that computer trading had abolished old-fashioned panics. The 1990s brought a new surge of optimism with the internet, convincing many that this time was different. Technology companies with no profits attracted billions. When the dot-com bubble burst in 2000, it wiped out trillions in paper wealth. Yet before its lessons were absorbed, a new bubble was already inflating in real estate, fueled by easy credit and the unshakable belief that home prices could never fall nationally. The 2008 financial crisis was a watershed, different not in severity but in revelation. It exposed how deeply interconnected and fragile the global system had become through derivatives and securitization. Problems in the U.S. subprime mortgage market froze credit worldwide, toppled major institutions, and brought the economy to the brink of a second Great Depression. The response was unprecedented. Trillions in bailouts, interest rates slashed to zero, and central banks becoming active market participants. These actions prevented total collapse, but created new distortions. For over a decade, near-zero rates forced investors into increasingly speculative assets, inflating bubbles in technology stocks, cryptocurrencies, and beyond, while the underlying economy struggled to achieve robust traditional growth. The eternal mechanism, human psychology. The persistence of this pattern across centuries demands an explanation beyond specific eras or technologies. At its core, the cycle reflects constants of human psychology. During expansion, optimism builds, success stories proliferate, recent failures are forgotten, and risks seem prudent. This optimism is not irrational. Genuine opportunities exist, and early movers prosper, creating powerful examples. As money flows in, prices rise, creating validating paper profits. Banks, seeing loans perform, lend more freely. This creates a self-reinforcing loop. Rising prices justify more lending, which drives prices higher until the structure becomes fragile and extended. The inevitable crash is the mirror image. Falling prices trigger defaults, which force credit contraction, driving prices lower in a downward spiral. It only ends when values fall so low that bargain hunters see undeniable opportunity. 2026, the critical inflection point. Projecting this cycle forward from the 2008 crisis and accounting for the unprecedented prolonged interventions that followed, 2026 emerges as a potential turning point of historic significance. The current expansion is among the longest ever recorded, sustained artificially by low rates and abundant liquidity. By historical measures, warning signals flash everywhere. Stock market valuations relative to earnings, sales, and book values are at extremes. Real estate in global cities has soared beyond the reach of average workers, creating social and economic tensions. Government debt has exploded to levels considered catastrophic in prior decades, raising profound questions of sustainability. Demographics add pressure, with aging populations in developed nations straining social systems and potentially reducing economic dynamism. Simultaneously, rising geopolitical tensions and internal political divisions weaken international cooperation crucial for managing crises. History suggests a system stretched this tight cannot maintain its equilibrium indefinitely. The multiplying warning signs. For the attentive observer, the signals of a late-cycle peak are evident, echoing past frenzies with eerie similarity. Speculation has gripped markets, with fortunes made and lost in cryptocurrencies and meme stocks, assets whose value often rests on collective belief rather than fundamentals. Stories abound of ordinary people quitting jobs to trade full-time, convinced they have found a shortcut to wealth, just as they did before the dot-com bust. Corporate debt has reached records, with companies borrowing cheap money to buy back shares and inflate executive compensation rather than invest in productive growth. Financial engineering has returned, with complex instruments obscuring true risk. Consumer debt burdens have climbed as people borrow to maintain lifestyles their incomes cannot support. Real estate speculation is again rampant, with properties bought not for use but for quick flips, creating neighborhoods of empty investments. Yet political leaders largely ignore these imbalances, preferring promises of continued prosperity to the difficult preventative measures history recommends. The profound human cost. Understanding this cycle transcends academia. It is vital for the millions whose lives will be shaped by its turn. A generation that entered the workforce after 2008 has known only rising markets and easy money. They have no lived experience of a sharp, systemic downturn. Families have stretched financially to buy homes at peak prices, taking on mortgage debt that could become crushing in a downturn. Retirees have been forced into risky assets in search of yield, placing their security in jeopardy at a vulnerable life stage. The young face the prospect of inheriting an economy burdened by massive debt and the immediate crisis of the cycle's turn. History shows that severe economic stress tears at social fabric, trust in institutions crumbles, communities fracture, and the desperate search for scapegoats fuels dangerous political extremism. The human cost is measured in broken families, lost dreams, and altered life trajectories, the true weight behind the economic statistics. Can the cycle be broken or only managed? This is the haunting question for economists and policymakers. Is the boom and bust cycle an inevitable feature of market economies or a solvable problem? One school argues it is inherent, wired into the human psychology of greed and fear that drives decentralized decision-making. Another contends it is amplified by policy failures, particularly in monetary policy and financial regulation, and that more intelligent intervention could smooth the extremes. The historical record is mixed. Aggressive responses like those in 2008 prevent immediate catastrophe, but can inflate larger future bubbles. Regulations designed to limit risk are constantly circumvented by financial innovation. Some advocate for radical reforms, changing how money is created, directly targeting asset inflation, or limiting leverage system-wide. Others warn such measures would stifle the innovation and growth that drive progress. The debate continues as the cycle advances, with the only certainty being that it will turn. The open questions are when, how sharply, and how prepared we will be. What history predicts for the turning? A survey of 150 years offers guidance for what may lie ahead as we approach the 2026 inflection point. Major crashes are typically preceded by expansions long enough for the memory of the last crisis to fade, allowing a new generation to believe this time is different. The immediate trigger varies: a bank run, a market panic, a commodity collapse, but the root cause is always the same: the excessive accumulation of debt, overvalued assets, and misallocated capital during the boom. The severity of the bust generally corresponds to the excess of the preceding boom. Recovery always comes, powered by human resilience and ingenuity, but its duration can range from years to over a decade, shaped by the crisis depth and policy response. Often, the most lasting consequences are socio-political, shifts in global power, new governing ideologies, and redefined relationships between citizens, markets, and the state. If 2026 proves a true turning point, we should expect not merely an economic event, but a potential catalyst for broad societal change. Navigating the inevitable. While the cycle does not permit precise prediction, understanding its pattern provides crucial insights for preparation. For individuals, the lesson is prudence. Be wary of excessive debt, question assumptions of perpetual growth, and build financial resilience even if it means foregoing final speculative gains. For policymakers, the immense challenge is to resist the political temptation to prolong unsustainable booms through ever greater intervention, which may only delay and intensify the eventual correction. For societies, the task is building institutional and social resilience, maintaining the cohesion and trust that enable collective action during hardship, resisting the pull of division and blame. Promoting economic and historical literacy can help populations understand complex crises and reject simplistic, dangerous solutions. In our interconnected world, international cooperation is essential, yet it is often the first casualty in times of strain. The eternal return and human resilience. As we approach what historical patterns suggests is another critical juncture, we do so with knowledge our ancestors lacked, yet burdened by the same human frailties. The story of this market cycle is ultimately our story, a reflection of our oscillation between visionary optimism and crippling fear, between self-interest and communal solidarity. It repeats not because we are foolish, but because the visceral lessons of the past fade with time, and the compelling realities of the present always feel unique. The cycle persists because it is embedded in the very structure of decentralized markets, where the aggregate of millions of individual choices produces emergent patterns no single person intended. Yet this is not a narrative of helpless determinism. Within the broad pattern lies vast variation in human outcomes. Societies equipped with wise policies, robust institutions, and deep reserves of social trust navigate the cycle's troughs with far less suffering. The significance of 2026 is not as a predetermined point of doom, but as a historical marker, a prompt for heightened awareness, deliberate preparation, and thoughtful choice at both individual and collective levels. The coming crisis, whatever its form, will pass. Recovery will follow, as it always has, because human creativity and resilience have repeatedly rebuilt what excess has undone. This cycle will likely continue for generations, not because we are trapped, but because we are human, infinitely capable of building towers of prosperity, prone to overreaching, and endowed with the stubborn spirit to begin again. The rhythm of boom and bust is the heartbeat of our economic civilization, and 2026 may be the next pulse we feel, reminding us of the timeless patterns we inhabit and the enduring strength we must summon.